All right, folks, time to take this is that chapter 8 tax homework problem in Connect. By the way, I know these can be pretty tough, and doing them in Connect can be pretty tough, but they're good practice, and it's not a problem for me to make a video to help you out with it. But let's go through it. So the first thing you have to do, and by the way, this is true no matter what type of tax return you're doing, is you have to go through the information and see, okay, what's going to happen with this information? Is it taxable or not taxable? Um, do we need to consider this when we're making our decisions? So let's take a look. So they tell us Reba, she's a school teacher. So they give us the salary. We definitely need to know that, right? Says she's 45 years old. That's fine. Now she gets alimony payments, $1,200 each month. A couple of important things. Number one, it's alimony. Notice they tell you each month. And then look at this date, 2016. Now, why that's important is because 2019 was when they did that change. So this is going to count towards income for her. It's going to be on what's called Schedule 1. Schedule 1. Okay. Now it says she also rents out a small apartment. So she got this much in rental payments. Again, this is going to be on Schedule 1. Schedule 1. And she incurred expenses. Okay. So that's going to, the difference between these two is going to be taxable income as well. All right. So there's the first part. Now she's got a daughter, Heather, 20 years old. She lives with her. Notice she provides more than one half of the support. So this is not going to be a child, but she's going to be a dependent. And so she's going to get that $500 credit. Okay. So it tells you they've been living in Colorado, blah, blah, blah. Anyway, then it says she paid a moving company to move and driving. The problem is this is not tax deductible. Used to be years ago. For some reason, they changed that. Not taxable, tax deductible. Not tax deductible. Okay. And by the way, that's unless you're military. Military has a different rule. Okay. So she rented to Georgia. Heather's going to live at home with her mom. Now notice she got a scholarship, partial scholarship this year. That's not taxable. And then Reba helped her out by paying $500 in tuition cost. Okay. So they're going to use that education credit. Okay. All right. And so this would have to be the opportunity tax credit. First 4 years. Okay. All right. Let's keep going. It says Reba wasn't sure if she'd have enough to itemize, but she paid this much in state income taxes, so that could be itemized. Put a little I under there. She donated $15,500 to charity. That's a lot of money. That can be itemized. And all of these are itemizable deductions. They didn't tell us anything about her work paying for the insurance premium, so that could be deductible. All except for this one. Non-prescription. So this one is deductible, and this one. Okay? So all of these could add up. These guys right here. Okay, those 4 plus the other 2. All right? Notice it says shortly after the move, she got into an accident, caused $900 to damage her car and whiplash. She paid the entire cost. There's nothing they can do with that. However, Reba wasn't able to work for 2 months after the accident. Unfortunately, she received $2,000 in disability insurance. Her employer paid 60% of the premium as a non-taxable fringe benefit. Okay, Reba wound up paying the 40%. So what happens here? The part that wasn't taxed, this 60% right here, right? This is going to wind up counting as income because basically the bottom line is with the government, it's going to be taxed at one time or another. Okay, and because she got it non-taxable, the 40% she paid for, it's not a problem. the 60% that wasn't paid for, that they paid for and they didn't tax her for it, that she's going to have to count as income. Okay. All right, let's see, whatever. She has several investments. So she got interest income from corporate bonds. We're going to need to know that. Okay. Interest income from City of Denver municipal bonds. Okay, that's not taxable. And then it says she's got a stock portfolio that increased by $12,000, but she did not. So this is NA, not applicable. She didn't sell anything. She got Heather, now this is the daughter, got $6,200 of interest income. Okay, so this is a potential kiddie tax issue, right? Because it's non-earned income. Remember, it's non-earned income. That's what they're looking for in kiddie tax. Okay, all right? And it was her only source of income. So when they ask us about Heather, it's all about this. And then they told her, well, Reba had $10,000 withheld. And says that Heather, this is for Reba, and then Heather made $1,000 in estimated tax payments during the year. Reba did not make any. Okay, so that's all the information we got. Now the question is, what do we do with it? So let's do a little calculations here. So here's the first one, alimony, $1,200 a month times 12 months. $14,400. Okay. Now remember that disability insurance. Okay, that's 60% that the company paid for. It's going to wind up being 60% of that $2,000 right here. Okay, and notice because she paid the 40%, it's excluded, but the 60% she didn't, and it wasn't taxed by the employer. This becomes income. Now the medical expenses. We're going to have to wait a minute to see this calculation right below this calculation right here. Okay, but medical expenses, this is what it totaled, all the medical expenses. This turned out to be her AGI, and remember, anything 7.5% times the AGI, right? That's the floor, the threshold. So this was the expenses minus the threshold. Gives her this much. This is going to be an itemized deduction. Okay. All right. Now she's going to be head of household, and we're going to see that in just a minute. And this is just the tax. Okay. So you have to look this up on the chart. Okay. Now, for the American Opportunity Tax Credit, okay, the $500 tax credit for qualifying dependents. This is good. This is fine. No problem there. She gets the whole amount. But for the opportunity tax credit, she only gets $185. And the reason has to do with a phase out. It's phase out. So she's in a phase out range, and we're going to see that in a minute. And it's partially refundable. And we're going to see this is actually going to come in two different parts. Refund. Okay. All right. Moving expenses, non-deductible. We talked about that. Medical. We talked about that. Okay. Now the first question, you have to know whether or not she's head of household. So here, this is Heather a qualifying child for Reba? Daughter, yes. Age, under age 24 and a full-time student. Yep, she went back to college. Younger than Reba. Residence, yep, she lives with her. And then Reba provided more than one half of her support. Okay? So she's going to be able to file head of household. So that tax calculation below was for head of household. All right? Now, let's take a look. So the $500 credit, that's not a problem. But here is that phase out for the American Opportunity Tax Credit. This is that phase out. So the phase out happens for head of household between $80,000 and $90,000. That's this right here. Okay? So she can't take the full credit. So what you have to do is you have to take the qualified expense times 1 minus the difference between these two, and this is $8,600, divided by $10,000. Okay, right? So basically what happens is, it turns out to 0.63, so she can only get $185. That's the phase out calculation. The bottom line is, the only thing, 1 minus, so she's able to get, notice it says 1 minus, so she's able to get 37%. Because 1 minus 0.63 is 0.37. Okay? Now, 40% of that is refundable. So this comes to them in the form of a refund. And notice it appears on line 29, page 2. And the remaining is on page 2, line 20. So basically that 185 is 74 refundable and 111 deductible. Okay. All right, folks, that's the first video for this tax return. We're going to come back with another one in just a minute.